Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates. 10-year note yields continue the slow decline. We see them kind of forming a new comfort zone, 285 to 295. Recall, not too long ago, we were looking at that 290 to 3% range as kind of being home base. Now we're even declining even lower. 275 is the line in the sand. You get below that, things are going to start to change. But I think there will be ultimately sellers at that 275 level. Likewise, probably buyers up near 3%. But ultimately, the bond market and those that are participating that are massively short want to see yields get back north of 310. That seems like it's a long way off. And if you look at market volatility, yeah, we saw a little bit of an uptick on the China news, on the trade wars, on the Twitter wars, whatever you want to call it. It's a lot of uncertainty out there. And we did see an uptick, a modest one, but nothing that you would have considered historically massive. And I think that that's one of the things that we're starting to digest here is that this information we're getting, we're seeing it, not seeing it priced in volatility, but we're seeing it priced in the bond market much differently than we had before. And look at gold prices down today. Look at treasury prices modestly higher, yields down slightly, equities the same. It just seems to me that the market right now is very cautious and waiting for that moment. And if you look at what's happening in treasuries moving forward this week, we've got some mixed data. Yeah, we've got some housing and some manufacturing data. We've got auctions, and we've got some Fed speakers. But ultimately, it's going to be all about what happens with trade and how the market reacts. And maybe the bond market will take its lead from stocks. It certainly isn't going to take its lead from the dollar. And I think that right now, with the dollar lower and treasuries slightly up, I think that the bond market right now may be the flight to quality bid that we're not used to seeing, at least this little. And for the time being, 275 is going to be your best resistance in yield speak. So right now we're very close to that. If we dip below 280, which is something we haven't done in a long time, that could be the signal that we're going to see yields continue to creep lower. Something that probably no one expected when the Fed started unleashing their balance sheet and when we started to see those leverage funds get massively short and the bond market trade to 310. So we've made a big reversal here. Bond market's still in no man's land, but starting to see those yields creep lower every day. This is Todd Colvin coming to you from the floor of the CME Group.